You usually buy two kinds of items, durables and non-durables. Now, are they really that different? Well, cars and Mars bars are really different, aren't they? It's due to the percentage of income they take up. Cars take up a rather significant portion of your income and they last for a long time. We call them durables. Mars bars don't really take up that much of your income and they can't last for very long. This is especially so in Singapore. The weather simply melts a Mars bar in 10 minutes if you leave it out in the open. So for durables and other big ticket items, you often find that you have to spend a significant amount of your money on it. So you either spend a lot of your savings or you borrow. So let's say that you borrow money first. If the interest rate increases, then the cost of borrowing increases. You have to return more money to the lender next time. In that case, where interest rate increases, your consumption of durables decrease because of the increase in borrowing costs. Now, an interesting question you may ask is, what if I don't borrow the money and I simply spend the cash that I already have on my savings? Well, the same reasoning still applies. Let's say that the car costs around $100,000, and let's say they have $100,000 cash on your hand right now. What else can you do besides buying the car? You can save it in the bank and earn interest on the money. Hence, if you spend money on the car, you forego the interest that you could have earned saving this money in the bank. What does that mean? This means that the interest rate is also your opportunity cost of present consumption. By consuming the $100,000, now you're giving up the interest you could have earned. So when interest rate increases, say from 5% to 10%, then you're giving up a larger interest by consuming instead of saving. You're giving up $10,000 instead of just $5,000. In that case, you'll be less inclined to consume due to higher opportunity costs. You may save instead. Hence, when interest rate increases, similar to the case when you borrow, your consumption of durables still decrease. Well, what about Mars bars? Well, I don't think interest rates have much to do with your consumption of chocolate. You rarely buy Mars bars unless you're still in primary school. And you rarely borrow to buy Mars bars unless you're still, 5 years old? So neither do you forego too much of an interest either. So what is 1% of $2? So interest rates only significantly influence the consumption of durables. When interest rates increase, the consumption of durables decrease. When interest rates decrease, the consumption of durables increase. Simple as that.